In this video, I'm going to help you determine the discount rate for a company's stock and the value of that stock. The first paper will be determining the discount rate, and the second paper will be for the valuation. Now, in picking a company, I am going to do Walmart. So I suggest you go to Yahoo Finance and type in the symbol of the company you want. You can't do Walmart because I'm doing Walmart. And then for those of that don't already have a company picked, you want a firm that has positive earnings per share, and that is paying dividends. Now, if the firm you want to do or are doing is not paying dividends, contact me. We can find a substitute for that number using free cash flow per share, but I recommend, if you don't already have your company picked, for those in the class that are getting to pick their own company for these papers, I recommend you pick a company that does pay dividends and that has positive earnings. You might also be a little concerned when you look at financials and look at the balance sheet. You may want to make sure you have a firm who has a positive equity. So if you look at the balance sheet financials and balance sheet positive equity, if you already have your firm picked, for those doing the same company all semester, if you don't have a positive net worth, it does cause some concerns for a couple of the inputs for the paper, but it's not disaster. But I'm using Walmart, and so in valuing Walmart, to get the discount rate, we're going to use the capital asset pricing model, or CAPM. You don't need to explain CAPM in your paper. You can if you like, if you want to use this as an opportunity to document what you've learned about CAPM and beta and those inputs, you certainly can. It's not required. You could give a short intro. I'm going to use the capital asset pricing model divided by William Sharp, which, whatever you want to put it in 2 or 3 sentences if you like. A more detailed discussion would probably be overkill for a paper like this. But we know that CAPM says the discount rate for stocks, often referred to as KE, equals the risk-free rate plus beta times the market risk premium. So for this paper, we only need 3 inputs. The risk-free rate, we generally use a treasury yield. So which treasury yield? The traditional approach is use the 10-year treasury yield. There are debates to use the 30-year, the 5-year, the 3-month. Those debates you can certainly look up and have them, but the traditional approach is to use a 10-year treasury. Just given the nature of that particular treasury, it doesn't have some of the supply and demand issues of the 30-year. It's not as volatile as using the 5-year or 3-month. So it has traditionally been the go-to yield curve. The market risk premium, we're going to use the implied approach. So we'll get the inputs for that. And then for beta, I have a 4-step process you need to walk through to essentially forecast or determine your beta. So we'll do that. So that is, in a nutshell, what we need for the first paper. 3 inputs, but there's going to be some additional analysis to do those inputs. For valuation, we need dividend 0. I'll show you how to get that. We need earnings per share 0. We need the KE from the previous paper. We need a long-term growth rate, which we're probably going to tie to expected earnings for the market in previous paper. We need a short-term growth rate, and I have 3 approaches plus your opinion that you can use there. We need an H, or the timing, for short-term growth, probably the most subjective number in the papers. And we need an inflation rate forecasts. And that we're going to tie to the inflation assumed in the previous paper. So you can see for this second paper, some of your assumptions you would have already used in the first paper, and as a result, you don't want to be inconsistent, so we'll tie back to that. Doesn't mean it has to be the same, doesn't mean that the long-term growth rate you use for your company will be the same long-term growth rate you assume for the stock market in the previous paper, but there should be some relationship. They shouldn't be radically different numbers. So these are numbers we need to get. So let's start with the first one, and that is the risk-free rate. And here what you want to do is acknowledge the very low rates previous years, but it's a little easier for you because the current yield looks reasonable now, so no need to adjust. That would be my recommendation. The current yield, the treasuries are up a lot. You might put in some graphs of the history to show rates have come back up, and the good way to do that is just try treasury yields and the word Fred in Google, and you can create those graphs pretty quickly. Let me show you. Over here I type treasury yield and Fred, and when I hit enter, the very first thing that comes up is the Federal Reserve site, and it shows me the history of the 10-year treasury. And so what you can do is use snip to bring in a chart. You can see this goes back to 2009. That shows you the recent history of rates in the 2 and 3 range, and then dropping down to 0.5 and now back up above 4%. You can show that chart certainly. And if you like, you can click on this max button and show a longer history if that shows you again that we're back into more decent ranges. We're still low versus the high inflation of the 70s, but we're still, you can see back in the 60s, 4.5 was pretty common, and since the 2000s, rates have been much lower. So we're definitely back to more normal levels. So you can think about that. I pulled it straight from Fred, which doesn't have the last few days here where interest rates have fallen back down. You can create your own chart. If you want to bring in the data, what I like to do is you can just type H15, and when you do that, the Federal Reserve site brings up the historical data, and then you can bring it into Excel. You have to get rid of the days with NAs, which is a little bit of a hassle, those holidays, but you can sort it and create your own charts. That way you have more control over how it looks. But if you want to keep it simple, this certainly makes the point that rates are back to normal. And so my risk-free rate will just be the current 10-year treasury yield. I can get that from Yahoo Finance. And so that rate is, here's Yahoo Finance, and you just click up here at the top. There's the 10-year bond. See, the rates have been dropping the last couple of days when we got that good inflation report a couple of days ago. So 3.81%. You're perfectly fine to round it to some point. 3.81, I'll just use the actual number. I'm going to highlight that in green so I know it's one of my key assumptions. So there's my one number out of the 3 I need for the first paper. The next thing I want to do is the market risk premium using the implied approach. If you want to explain the implied approach in your paper, that wouldn't be bad. It would look good on LinkedIn. So the implied approach assumes markets are efficient such that the expected return on stocks for the market should equal the required return on stocks for the market. That makes sense. If the market's expecting 10% and requires 10%, stocks are well valued. If they're expecting 8%, but the market requires 10, and stocks are going to sell off until the prices are low enough to give you that 10% that you require. So that's the key. The market risk premium equals the required return on stocks minus the risk-free rate. We can't get the required return on stocks from any source. That doesn't exist, but we can come up with an expected return on stocks. So the expected return on stocks, we're going to use that as a substitute for the required return on stocks. We're going to say that that is a function of U.S. nominal GDP growth. We're going to assume that stocks earnings grow about the same speed as the overall U.S. economy. I have some charts out there that you can use for that. So if you look on Blackboard, I have these charts that show you that. So here's a chart you could certainly put into your paper that shows that corporate earnings in the red have somewhat tracked GDP growth in the green. In fact, here recently, the long-term growth has been almost identical, 6.41% versus 6.47%. So corporate earnings growth have been a little slower than the economy, mainly because this red line is the S&P 500, which are large companies. So there's probably some smaller companies that are providing extra growth. But we can certainly put this into the paper as justification that we're going to use economic growth as our proxy for corporate growth. And so if that's the case, then nominal economic growth is going to equal productivity growth plus labor growth plus expected inflation. So we have a chart for that as well. It shows you the history of those numbers. So this is another good chart that you can put into your paper. And looking at this history, you can see productivity has ranged from 2 to 3%, although it's been a little weak here lately. So about 2% has been the history. Labor growth has been anywhere from 1 to 2. Recently, it's been much lower, very, very low in the 2000s. In this last decade, it's been more like 1%. It's averaged more like 1.5%, but that's pretty high. And then inflation's been all over the place. The last couple of years, it's been pretty tame, below 2%. The history has shown about 2%. So these are your medians over here. So you have to have a little bit of discussion here. So here's where you get the critical thinking points. If you just use history and say, oh, the economy is going to grow 6%, 2% productivity, 2% labor growth, 2% inflation, that's certainly what the historical median suggests. A much stronger paper would put your perspective on each one of those. What do you think productivity will be going forward? What is artificial intelligence, autonomous vehicles, who knows, robotics, the Internet of Things? There's all kinds of things that can make us more productive. What do you think labor growth is going to be with the retiring of the baby boomers and immigration? And then inflation, what do you think inflation might be? You want a long-term perspective on inflation? So I'm going to put this is just my numbers. You need to come up with your own. My productivity growth assumption, I'm going to use 2.5%. I'm hoping artificial intelligence and robotics and some other things will be pretty powerful. Labor growth, I'm going to say, yeah, the baby boomers are retiring, but we'll have better immigration to help get more workers into the United States. And so I'm going to have some labor growth. I'm not going to have the retiring of baby boomers give us negative labor growth. And then for inflation, I know the Fed says they're targeting 2%, but I think that's going to be a tough number to keep going. I think they would do too much damage to the economy to try to get back down to 2. In fact, 3 might be a more reasonable number. But here's my expected nominal GDP growth. So 5.5%. And so my expected return on stocks, it's going to equal current dividend yield plus expected earnings growth. Now, if you like to, you can adjust and add in the buyback yield, maybe 1%, as much as 1.5%. I wouldn't go above 1.5%. Firms are buying more stocks back now than they're paying dividends, and because of that, you might want to put that into your assumption. It will give you a higher expected return for stocks and a higher market or risk premium. So your choice on that. If you want to do that, I've provided that paper that gives you some of that discussion. So the current dividend yield, I can get that by looking for SPY, the security SPY on Yahoo Finance, and get its dividend yield, because that SPY is the S&P 500. It is the market. So if I go into the Yahoo Finance and type SPY and look on the summary page, I can see that the current dividend yield is 1.6%. Make sure you look for it on the day you do your paper. It's going to move around as the stock market moves around. Expected earnings growth is 5.5%. If you want to put in the stock buyback yield, you'd put it between dividend yield and expected earnings growth. So the expected return on stocks is going to be 5.5% plus 1.6. Anything in the 6% to 8, maybe 0.5%, depending on what you do with the earnings yield, is probably reasonable. 6% might be a little low. I'd recommend you try to get above the 7. That's where it really helps to get the buyback yield in there. It gives you a little bit bigger numbers. You'll see why when we talk about the expected growth for your stock. And so that gives us a market risk premium of 7.1% expected return on stocks minus our risk-free rate, 3.81, gives us a market risk premium, a pretty low one. So here, 3% to 6% is probably reasonable. Now let's talk about beta. For beta, what we need is an understanding of the company and some history. So beta is not a number we can just look up in Yahoo Finance. Yahoo Finance does have a beta for our company, but that's just the beta for the last 5 years using monthly data. That might not be the best way to do beta, because the last 5 years might have been unusual. You might have had a global pandemic or who knows what, recession. So here we have several steps. You want to go through these steps. You can title the sections whatever you want to title to make it more intriguing. But the first one, we wanted to find the company, and I call that revenue sensitivity. Essentially, we want to ask, is it defensive or cyclical? Defensive means has a low beta, well below 1. Cyclical means above 1. And to what extent? So I'm doing Walmart is definitely a defensive company. I could talk about the type of products it sells, low cost, discount store. I can also talk about how well they did in 2008 and 2020 when everything else was selling off. This is certainly a firm that can do well in a recession, at least do better, much better than the average cut firm. It does groceries, it does low cost goods. So I'm going to say defensive. You can have some discussion here, definitely. Step 2, I'm going to ask about the degree of operating leverage. How much fixed cost in the cost structure? Because here, if a firm has a lot of fixed costs, then that means their net income is going to be more volatile, and that makes them more risky. So if they were a low beta company, but they have a lot of fixed costs, that might push their beta up closer to 1. If they're a high beta company and have a lot of fixed costs, it might push their beta even higher, further away from 1. Or if it's a cyclical company but with low fixed costs, that might move their beta closer to 1. It probably won't flip a company from below 1 to above 1, or flip a company from above 1 to below 1, but it will move it further or closer away from 1. So for Walmart, I would assume low operating leverage given the large hourly workforce, but put some subjective in there. Do they have a lot of property, plant, and equipment? Do they have a large research and development? Do they have salary workers? So there's, in the notes, there's a list of things to consider. But the other thing we can do is we can assess the volatility of their net margin, because a firm with high operating leverage should mean more volatile net margins. That's my theory, but I think it's perfectly logical. And we have a table that shows that. So you have in Blackboard a file that shows you how to get the beta. So what you do, first of all, you go to the pace values part of it. So you go to the pace values part of it and find your company. And I can see that Walmart's on line 2963. And so I can change my reference here to 2963. I have the gross margin in there. It's not that critical. I do find it interesting, but I'm going to use the net margin, make it look professional. And so I have a lot of extra columns here we don't need. I'm going to change the inside to white. I don't need all that extra space, so make it really, really good. I don't like the word Inc., so I'm just going to change it to Walmart. There's a stock market. So I've got it. So let me now copy that in. May not be good enough for the paper, so I might do a little bit more. As you can see in the chart, Walmart's volatility of net margins, 0.072% standard deviation, is much lower than the average stock in the market, 7.40% standard deviation. Walmart ranks in the top 3% for having low standard deviation of margin. Now, what I can offer here is if you refer to this 0.72% as their net margin, it's not. Their net margin is not 0.72%. It's probably more like 8 or 9%. This is the standard deviation of their net margin. It's 0.72%. The standard deviation of stocks in the stock market, their net margins have a 7.4% standard deviation. So Walmart is much, much lower volatility than the typical stock. Step 3, maybe the easiest, is looking at financial leverage. The amount of debt. And here, all you need to do is just pull the table. So we have up here the debt to equity. I'm going to format it a little better so we can see. As you can see in the table, Walmart's debt level, debt to equity of, and this is 62.38%, is slightly higher than the average stock in the market, 56.42%. So what do I have so far? I think Walmart's a low beta stock because they're defensive. They have very low operating leverage because they have very, very stable net margins. So that also implies a very low beta. Their debt to equity is slightly higher than average, but not much. So that's probably not going to have much impact on my final beta. But it's at least I've assessed it. And then step 4 is let's look at the historical beta. I like to use a rolling beta using monthly data over rolling 5-year periods. Why do I do that? Because that's the same thing Yahoo Finance does. They just show the very last 5-year period. So to do this, we need to bring in some data. So let's bring in some data. What do we need? I'm going to put it on a second sheet. I can even call this beta, so I know that's where I'm calculating my beta. I do recommend you do this in Excel just like I'm doing it, and then you just transfer it all into a discussion in your paper and copy charts in. So for Walmart, if I go back to Yahoo Finance, I find Walmart and I click on historical data. I'm going to ask for the max. I'm going to ask for monthly, so that's very important. You want max and then you want monthly, then you hit apply and then you can download that. And once I have it downloaded, all I need is the adjusted close. I don't need volume, so I can delete that. And I don't need close, I just need adjusted close. Remember, adjusted close, adjust for dividends. I'm going to change it so that it's got commas. And so I can take this whole thing, Control Shift down and right, and do Control Copy, Control C. And I'm going to put it into my spreadsheet here. So there I have Walmart. I'll put Walmart at the top. Now that we have the Walmart numbers, I need to bring the market numbers in. Unfortunately, Yahoo Finance no longer allows us to download the S&P 500 data. We have to copy and paste, and it's a little messy. So what I've done is on Blackboard, there's a file that gives you the S&P 500 history. It goes through October, which is all we need, October of this year. So I'm going to take the numbers here for the S&P 500 off of that file and copy them and move them to my file so that I now have the S&P 500. So I've got Walmart, I have the S&P 500. If I control down, I can see the dates are all lined up. So what I need now is a holding period return for Walmart and a holding period return for the S&P. Holding period return, you just take the current month's index or price divided by the prior month minus 1, and that gives you the return. So I can copy that down. So I have Walmart's holding period return, S&P's, and so I've got all the data that I need. And then I'm going to do the rolling beta, and to do a rolling beta, what I need is to decide how many years or months I'm going to do. So I've decided to do a 5-year beta, rolling beta using monthly data. So I'm going to put a 1 next to the first return, and then I'm going to do equal that plus 1. So I'm just going to count down, and I'm going to copy that down to about, I don't know how many, until I know for sure I've got 60 in there. So there's row 60. So that's the first 5 years right there. So I can Control Shift and get rid of those. Control Shift, get rid of those. So here I can put the beta. So I'll put the rolling beta here. I can put the median here. And then I'll put the 10th percentile and the 90th percentile. So the rolling beta is going to, the first 5 years, we're going to use the beta formula, which is equal slope, open parentheses, do Walmart first, Control Shift up, comma, do the S&P 500, close parentheses, and that gives us our beta. I'll put the formula over here on the side. So there's our beta, starting for beta. Now it's really high, but the reason it's really high is we're back in the late 80s, where definitely Walmart was a small company, not considered the large low beta company is today. So rolling beta down, so copy this down. So this gives us betas for every 5-year period ending for each one of these dates. If I do Control down, I see that the very last one is 0.53. So if I go back to Yahoo Finance and put Walmart in, I'll look at that last beta for Walmart, the one that's shown on Yahoo Finance. For the last 5 years, they show it as 0.53, and that's the same as what I have. And those should be the same or very close. It just depends on exactly how Yahoo Finance calculates their beta, if they use the intra-month data. We don't have any November data in here, just October, but we get the same number they do, so that's good. I can Control back up. Now I can bring in the median, and I can lock that in using the F4. If you're using a Mac, then just make sure you have dollar signs before the F, before the column, before the row, so that it locks that in. We can copy that down. We can do the 10 percentile, so equal percentile, just spell out the word. Highlight the rolling betas, lock that in, comma, highlight the 10 percentile. So 10% of the time their beta is 0.24 or lower. And then 90% of the time we can do slope. Same thing again, highlight that, lock it in. And so I use the median function. Put that formula on the side so you can see. And the percentile. Those are the formulas that I did. I can copy this down. And now I can do a graph. And so for the graph, I'm just going to highlight those 4 columns. So Control Shift down and go right, and I'm going to insert a line chart. I need to edit the data a little bit, so I'm going to select the data. I want to get the dates in there, so I'm going to edit the dates, go up to the top, and click on the dates, Control Shift down. It gives me my dates. And so I can give it a title, Walmart rolling beta, 5-year rolling using monthly data. And here's the data, so I can edit my titles. The first one is, the title is the rolling beta. The second one is the median, and do make sure you have good titles and formats for your graph. The third one is the 10th percentile, and the next one is the 90th percentile. And so here I have it. Now it looks like it's 2 companies. If you have something like this, you could actually rerun it, and I could have just rerun it from 2005. Because you know my median is really influenced by that early period of time. So I could redo the whole chart and just start maybe 12/31/2004 or something, just so I have a different chart. But if you're not seeing that, if it's just kind of all over the place and there's a nice median, that's good. So this median really is too high because it's pushed up by this period over here. So, but I'll stick with it for right now. Let me copy that and I'll bring it over here. And now I have my rolling beta. And so you want to have your final beta. And what I recommend is that you build a table of some kind that does the different pieces. So revenue sensitivity, I would say 0.4 to 0.7. I'm going to say definitely a defensive stock. Operating leverage 0.4 to 0.6. I might bring that upper end down. So low operating leverage given large hourly workforce and low standard deviation of net margin, something like that. That might be too much for a table. Financial leverage, maybe that takes me up a little bit, 0.45 to 0.65. Debt slightly above the average stock. And then history, that suggests 0.2 to 0.6. Median is 0.6, but that is high given high starting rolling betas. So 0.6 can be my upper end, even though on the graph 1.2 is the upper end, but that's because of that long history. So 0.6 definitely the high end, 0.2 the low end. So my final beta, I'm going to use 0.6, and in some of my classes, like in security analysis, I recommend that you have a 0.6 as your base case, but then you can run a high case and a low case. So you might use 0.7, 0.8 as your worst case scenario with the highest beta, maybe use 0.4, best case scenario or lowest beta, but just have some basis for your final conclusion. And if you put all these down in your paper at the end with a summary table, then you get credit for having considered all four of them in your final answer, and you don't just look at the history chart and use that. So highly recommend you do that. And so this is my final discount rate. So it's going to be the risk-free rate plus beta times the market risk premium. And so for that, my risk-free rate plus, where's my risk-free rate? Right there, 381. That plus my beta times my market risk premium. Where's my market risk premium? Right there. That gives me a discount rate for Walmart of 5.78%. Now, very, very important here is that discount rate becomes a cap on how high your long-term growth can be. Your long-term growth cannot be higher than your discount rate. So that's one of the reasons if you get a really unusually low discount rate, you might go back and add in that buyback yield into your numbers so you can get a slightly higher number. For Walmart, this is okay. My long-term growth for Walmart will not be above 5.78%, so I'm okay with Walmart. So that finishes the first paper. That's your goal for the first paper. So now what we want to do is the valuation. I'm going to move the valuation material down below here. And so let's look at the pieces that we need. So we need dividend 0. So for dividend 0, what you do there is you click on historical data and you click on, well, it doesn't matter, daily, but we're just going to do dividends only and apply. And what the dividend 0 is, it's the last 4 dividends, or the last year of dividends that they paid. So Walmart pays quarterly, so their last 4 dividends is the last year. So the last 4 quarters, 56 3 times and 55 1 time. So plus 0.656 times 3 plus 0.55. So their dividend is $2.23. Their earnings per share, we can go back to the summary page. Remember that was $5, so we can bring that in. The KE, we can just bring that down. And then long-term growth, okay? I would go back and say, from prior paper, I expected stock market earnings growth to be, I'm going to go get that number. Let's go find that number again. Expected earnings growth was 5.5%. To me, Walmart is an end of cycle mature company. To me, a firm like Walmart, especially once they get through there's any short-term growth, once they do any overseas expansion, they get their curbside pickup going, they have any internet sales, they expand, all the stores in the U.S. they're going to buy, they become a mature company. About the fastest they can grow is essentially population growth plus inflation. So I think for Walmart, my number, I'm going to use 4.5%, maybe 2% population growth and 2.5% inflation or something like that. It is a global number because they do sell overseas, but I think 4.5 makes sense. Remember, your long-term growth must be lower than your discount rate. And so in this case, it is. 578 is my discount rate. 4.5% is my long-term growth. Then let's do short-term growth. So let's look for let's get some perspective. We're not going to say these are our forecasts. We can do some perspectives. So remember, the first thing I gave you was the peg, or let's look at history. So the history of growth, here's where if you have capital IQ, you can bring in the financials for the company. I'm going to do that just so I have them. So if you don't have a capital IQ account, I encourage you to get one. You just go to the UTSA library. So my UTSA, find databases, and go to the C for capital IQ and just find capital IQ and click on that, and then you sign in, and then you have to log in to capital IQ as well. So when you get into capital IQ, you get a screen like this. So I'm going to put my company in there, Walmart. There's Walmart right there. And over here, income, I'll just click on the income statement over on the left. I want more years. So you see up here, I'm just going to bring the years back as far as I can. And then there's a button right here. It says download financials. I don't really need that. I just need this page, but you can download financials. That gives you a lot more information. But here I just need this page because all I need is their earnings per share. So I'll bring that in. And so I've got some numbers here. that I can use. Let's see. Here's my well, let's do their dividends per share. They didn't start paying dividends until a few years after this data starts. So let's put a year in there. What is the first year they have? 1979. So let's do 1979. I'm going to add 1 year so I can have all the future years to see how far out it goes. So my last one is 2023, but that may not be 2023. So you can see that last column is actually the last 12 months. We don't want that. I'm going to delete that column. All right, so I have them from 1979 through 2020. I've got their earnings per share, their diluted earnings per share, and their dividends per share. So I'm just going to bring all those over. They even show the payout ratios. So those are all things we need. So you can use Capital IQ to get a lot of this data. So let's look at the history. I'm going to put it right here. Let's put it in a format we can actually use here. So you don't have to use Capital IQ, but I do encourage you to learn it enough that you can say you have it. So let's just historically look at 10-year growth. So 10-year growth, you need 11 periods of time. So I'll start here with the growth rate, and I'll do the first number the ending number divided by the original number raised to the 1 divided by 10 minus 1. Really high growth, right? Because they're a very small company. I can do the same thing on the dividend. Now there it doesn't work because their starting dividend was 0, but we still have it. So I'm going to copy these over. So Control C, go over and copy it over. Control C, copy it over. So there's my growth rates. So I'm going to move this one down below and call it EPS 10-year CAGR, compound annual growth rate. And then the next one is dividends per share. So I can bring that one down. The first few years are 0, so we can't have growth rates. So I can show these growth rates. You can do it as a graph. You can see for Walmart growth, select data, let's put the year in there. We start in 1989. Let's edit our series, earnings per share. Dividends per share. I'm going to bring this over here. I'll have to bring the stuff below further down. So I'll move it quite a ways down. So there's the historical growth. That shows that in the last few years they've been well below 10%. So the historical growth implies something in the, I don't know, maybe 4 to 6% range. It's not spectacular growth. Obviously, they're a smaller company early and can grow really fast. Then they're growing really strongly there for quite a while there, 15, 10, 15, 20%. And then as Amazon has taken over the industry and caused a lot of competition, their growth has really dwindled. So you can see last few years just barely keeping up with inflation, kind of bounce around. They got a little bit of a bump from COVID, but history suggests that. So that's one thing you could do. If you can't get this data, then you'll have to use these other two approaches. The second approach is the PEG ratio. So in this approach, what we need the forward PE ratio, and we need the PEG ratio. And then we get analyst expected growth will just be the PE ratio divided by the PEG ratio. Because the PEG ratio takes the PE ratio, the forward PE ratio, and divides it by what the market thinks earnings growth will be over the next 5 years. So it gives you a number. So let's go find these numbers. You can get this from Yahoo Finance Statistics for your company. So if I go back to the internet and then click on statistics, I'm going to use the last quarter available. I'm not going to use current because it can get distorted. So their forward PE is 22.94, 22.94, and their PEG ratio is 3.84. So that gives you expected growth, the PE ratio divided by that. You need to take that whole thing and divide by 100, and that gives you 5.97%. Real consistent with the history. Essentially, they think they're going to go somewhat flat on earnings growth. So that gives me a second number. A third number is what we call sustainable growth. And here what we do is we take return on equity times retention, where retention is 1 minus the payout. So let's look at return on equity. I'm going to go back to my Capital IQ, and I'm going to actually download financials so I can get the return on equity. If you don't get it from Capital IQ, you can get return on equity from Yahoo Finance under statistics. The problem is it's only one number, and so that one number might be distorted because something unusual might have just happened. So in that case, you're probably better off looking at a few years. That's what I'm going to do here. Look at a few years to see if we can get what's called a normalized return on equity. So let's bring this data in. So let's look at ratios. And here's return on equity right here, starting in 1981. So I'm going to bring that over. Just copy it. 1981, 1982, copy that over, 2022. And so what I want to look at is the last few years and see if we can get some sense. The last year, 15.5% looks pretty reasonable. Let's look at the average the last 5 years. 1, 2, 3, 4, 5. Let's look at the median. The nice thing about a median is not distorted about outliers. 14.5, 15. I'm going to go with a normalized ROE of 15%, and then the retention, it's going to be 1 minus the payout. Remember up here we have the payout for Walmart, and you look at the last few years, we can do the same thing. The average last few years, 1, 2, 3, 4, 5, and the median, 1, 2, 3, 4, 5. Yeah, I'm going to say 45% looks like a reasonable number there. So retention is going to be 1 minus the payout. So 1 plus 1 minus 0.45. And that means they pay out 45% of their earnings and they retain 55% of their earnings. And so here, your sustainable growth, it's just going to be those two multiplied by each other. And that gives you the highest number. Now, you might say sustainable growth isn't that long-term growth, but actually sustainable growth really is short-term growth. You're talking about what they're doing today. not what they're going to be able to do 20 years, 30 years from now. So it really is a short-term number. So if we look at our numbers, history suggests 4 to 6%. Analysts in the market are expecting something closer to 6%. Their ROE and retentions assign something to about 8%. Those in my security analysis class, you need, you can have multiple scenarios on both the short-term and the long-term growth. But if I were doing this, I would say, I'm going to say 7%, but I have to put some words with it. I'm going to look at curbside pickup, the internet. I think Walmart's actually doing very well on that. Overseas, especially Latin American expansion. I'll say that they could see some good growth. I think especially on the curbside, where there's more and more idea of curbside, and COVID definitely changed our buying behavior. Consumers may be more open to ordering online and picking things up rather than let someone else do the shopping. They pay $5, $10 for that. As that becomes more commonplace, more people will do it, and Walmart has an advantage there in that they have so many more stores than Amazon or Target do. So I think they could pick up some market share doing that. So I'm going to go with 7%. Now, how long will that take? So we're saying short-term growth is about 4.5%, but they're going to grow 7.5% for a while. How long would that work? And that's incredibly subjective. I'm going to say COVID sped this up, but we are still early stage on curbside and overseas. Even they have a lot more they can do. So I think 8 years to fully implement these strategies, something like that. You really are just making up creative writing, but it needs to be reasonable. So if I think it's going to take 8 years, your H is 1/2 of that, which is 4. So I'm going to assume 4 for an H. And then my inflation rate, I have that in up above. Let's see if we can go find it. I assumed an inflation rate somewhere. We want to use the same number. So there it is right there, D76. So I've got all my numbers. So all I have to do now is plug this into the models. If you're doing a one scenario, then you have one formula. If you're doing multiple scenarios, you can do a data table, or you can run 3 or 4 scenarios. You can do that in both of my classes. You want to get more sophisticated, get somewhat out of a range. But we're going to do the dividend discount model, the capitalized earnings model, and the H model. Remember, on the dividend discount model, you don't need to explain that one. You just say it's dividend discount model and use it because everybody knows that one. This one needs an intro. You got to say this is a model I got from a professor at UTSA, and the assumptions are you can get that from the notes. And the H model probably needs a little bit of an introduction as well. And so what are the formulas? Well, for the dividend discount model, it's dividend 0 times 1 plus long-term growth. All of that divided by KE minus long-term growth. So dividend 0, I didn't put the 0 in there. The capitalized earnings model is almost identical, except for instead of using dividends, remember we use earnings per share, and instead of using long-term growth, we use inflation. And then the H model is almost the same as the dividend discount model, except for here, we're going to add something to the numerator. We're going to add plus dividend 0 times the H times short-term growth minus long-term growth. Make sure you practice, you got your numbers in there, that you have the parentheses in the right place. So let's calculate these. So dividend 0 equal, let's go find dividend 0. There's dividend 0 right there, times 1 plus long-term growth. There's my long-term growth, divided by KE minus long-term growth, and that gives me 181.49. The next one is EPS 1. My EPS is $5 times 1 plus inflation. There's my inflation divided by KE minus inflation. That gives me 156. And then I'm going to actually put an apostrophe before the dividend one and copy it down so I can use it. And then take that apostrophe out, and then I'm just going to add that middle section. Plus dividend 1, that's D137, times H, there's my H, times short-term growth, my short-term growth was 7%, minus long-term growth, my long-term growth was 4.5, and that gives me 198.86. I'm going to put an apostrophe there again so I can copy it down. And what I want to do here is I want to check it. So I'm going to take the first part of the dividend discount model out. So I just have dividend times H times short-term growth minus long-term growth. That should be the difference in the dividend discount model and the H model. So if I take the H model minus that, I get 181.49. So I know I don't have a formula problem, so I'm in good shape. Then what you need is the actual price, and you might get the date for that. So we're going to do 11/11 is the date I'm doing this on. So I'm going to go get the actual price for Walmart. And Walmart is currently trading for $142.58. And so I would put a buy recommendation. Why? Well, you can look at the average of your 3 valuations. And the average of your 3 valuations is trading 25% above the current price, as average valuations is 25% higher than current price, and current price is below my lowest. You see my lowest valuation is 156.06. The stock's trading for 142.58. So that gives me more confidence that I have some protection. Now, your stock might be trading for 220. Then you might put a sell recommendation in. Or your stock might be trading for 180. Real close to your valuation. Then you put a hold recommendation. So your options are buy if the current price is much lower than your valuations. It could be sell if your current price is much higher than your current recommendation, current valuations. Could be a hold if they're close. Look at the upside and downside. You know, what's the range here? So your stock might be trading for 175, so it's kind of somewhat in the range. So those are kind of questions you have to make. That's your critical thinking to end up the paper. Now, I didn't write the paper here, but if you build this Excel spreadsheet and go through all of these steps, you can definitely write your paper and even copy and paste some of these graphs over to your paper. And essentially, your paper is to explain what you did. Make sure you explain every single thing you do. You have to do this rolling beta. You can't go grab a beta from some online source. You've got to do it yourself. And then I don't need the Excel spreadsheet, but you need the Excel spreadsheet to get all of your valuations. So I'll put this Excel spreadsheet out on Blackboard so you have it to look at. But hopefully the process makes sense what we just went through. Thanks.